Hi everyone. Domino's Pizza reported fiscal 2022 fourth quarter earnings results. Of course, Domino's is one of my top 23 stocks to buy for 2023. I'm going to update that recommendation in this video, so you're not going to want to miss out on that. So I'm going to do you a brief review of Domino's earnings results and update that recommendation. So let's get right into it. So revenue increased by 3.6% to 49 million. Earnings per share increased slightly to $4.43 in Q4. That was up from $4.25 in the same quarter the prior year. US same-store sales growth of 0.8% was underwhelming. International same-store sales growth of 2.6% was a little bit better. The company added 361 net new stores in Q4 and 1,032 in all of 2022. That was about 5% growth on the year, as store count as of January 1 stood at 19,880. So why did the stock fall by double digits after, looking at these figures, you would think that it doesn't justify a fall of double digits, and it's because of what Domino's did for its long-term outlook. It lowered its 2 to 3 year outlook for retail sales growth to a midpoint of 6%. This was down from the midpoint of 8%. And it also decreased its store growth outlook to 6%. This was down from 7%. And the reason most likely is that this quote that I have here from Domino's management saying, we experienced significant pressure on our US delivery business in 2022 and focused our efforts on creating solutions. Now, this has been a difficulty for Domino's for at least the last 4 quarters. Consumer demand has remained robust. However, Domino's is having difficulty supplying that demand, right? It's having difficulty hiring enough drivers to meet that robust consumer demand as economies have reopened, and Domino's has had to compete with other businesses for labor. For labor is where it's had the most difficult competition. Some investors thought Domino's would have competition from other restaurants in terms of capturing consumer demand, because when we were in lockdown, consumers could not eat at restaurants. Remember that? But as economies reopen, restaurants reopen, consumer demand is still strong at Domino's. People still want to order Domino's. Where Domino's is having difficulty in competitiveness is now that the restaurants that were closed reopened, and they've hired back a bunch of labor, and all of that demand on labor is what's hurting Domino's, right? The increase in demand for drivers is not just coming from other restaurants, but it's also coming from DoorDash, Uber, Lyft, and all these companies that experienced a rebound in consumer demand. Drivers are now saying, hey, if I want to drive, why would I go drive for Domino's when I could go drive for a DoorDash or an Uber or a Lyft, where I can pick my own schedule? I've got more flexibility. I've got potential for higher earnings compared to Domino's, and so Domino's is having difficulty. That's where the challenge is, and there seems to be no end in sight to that challenge unless we enter into an economic recession where there's mass layoffs at other companies, and that in that way Domino's can capture some of that labor that comes out of other places, right? Because they need to do layoffs. Domino's sales is not as much at risk to a recession as other companies is. That's partly why I had Domino's in my top 23 stocks to buy for 2023, because I was expecting a more significant decline in consumer demand as the Federal Reserve raised interest rates. That has not yet materialized, but if it did, then some consumers would go to Domino's more often because it costs less to feed your family Domino's pizza than it does to go almost anywhere else out to eat, right? For less than $14, you can get yourself you can feed a family of four at Domino's, at least in the US, right? You can order two medium pizzas for pickup, and that'll cost you less than $14 with tax, and it feeds a family of four, right? Where else can you get that kind of value other than making the food at home, right? Other than making the food at home. So that was the thesis behind the recommendation for the for being one of the top 23 stocks to buy for 2023. However, I am changing that recommendation because of the change in the long run outlook. Right? When management said that they got a lower long-term growth prospects because this labor challenge is so sticky, this means they don't expect to be able to solve this problem anytime in the near term. So, for that reason, I'm changing my recommendation. Domino's is no longer one of my top 23 stocks to buy for 2023. All right, that's the third stock that I've removed from my top 23 stocks to buy for 2023. If you're familiar with my previous video, I highlighted I removed Chegg stock from my recommendations, and I also removed Mercado Libre stock from my top 23. Mercado Libre, because it increased so much to start the year, I took it off. But I will link my top 23 stocks video to the end of this one. So if you want to remind yourself of those stocks and then of these changes, if you're keeping tabs, feel free to do so. All right. So thank you so much for watching. I really appreciate your viewership, and I hope you'll see me again next time for another video. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.